Our asset class allocations for next year, as I said, as we will go into an environment where some rate cuts will be needed. We see 3 from the Fed, and also we see 3 from the ECB, also starting around the same time, mid of next year. You will see an environment where that is beneficial for the bond market, but also for the equity space, because the overall backdrop that I was explaining is not that we need to address a recessionary scenario. It's because we are in restrictive territory. Inflation is starting to move the other way, and it's an environment where you can start normalize rates. So what that means is for the bond market, we still favor the investment grade credit, especially once there is a higher conviction around a recession being in the rearview mirror or not even having to deal with it. Then it may also be the high yield space that is getting interesting towards the second part of the year. And also on the equity side, this will be beneficial. So we see also high single digit returns on the equity side. And of course, you know, there's lots of risk around, and we just talked about one very short-term one coming back into the mix. So to counter these risks, you make sure you are as well diversified as you can be. You add gold, you have alternatives in the portfolio, and you manage all of these risks very actively.
How much allocation to gold and alternatives?
Well, if you look at the balanced portfolio approach that I explained before, I would say a 45, 45, 40, 40 for bonds and equities, and the rest will go into alternatives and gold.
So 5 to 10% is the standard.
Yes.
You like semiconductors and luxury goods. I get the semiconductor story. It's played out every year, right,
Yes.
over the last 3 years. But luxury goods, China is a very important market for consumption there, no?
Yes, absolutely. But you've seen the luxury goods sector also being a sector that had seen a lot of support, not just from China, which had been underwhelming anyways all of this year. And we've also seen a consumption downgrade. You know, we now look at it like we call it the B1, B2, so where consumers not shop into the higher floors of the big shopping centers, but look at the one that are better priced. But overall, the luxury goods sector will be supported by a consumer that is still in a good position in the rest of the world. So you look at Europe, for instance, you know, the consumer is very much driving the growth outlook. And therefore, the ability to still consume and to participate is also something that we see the sector being well supported.
What do you think about gold? It's getting some love of late, especially with the weakening of the US dollar.
Yeah, gold has so many stories to it. So the weakening of the US dollar is one part of it, but I think a trend that we've seen for a long time now, and that is actually picking up even more momentum, is the diversification of central bank reserves into gold. And, I think we understand the geopolitical backdrop that is making this attractive. But then again, if you look at an environment where still we have inflation that is relatively higher than before, and some other sectors challenged, I think gold is just a good mix to have in the portfolio. You add on top of that geopolitical risk, and we have already touched on one of those in the Middle East. I think just gold is something you cannot forego in the portfolio going forward, and we see some more upside from here.